Good morning and welcome to today's webcast, How to Qualify for Federal and State R&D Tax Credits. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only one sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, thank you everyone for joining us today. We are going to kick off the presentation with a polling question. And our first poll is, are you familiar with the R&D tax credit? And your options are yes or no. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit Submit. And if you are having any difficulty seeing the polls, you may try refreshing your browser with F5. I'll give everyone a couple more seconds. And let's go ahead and take a look at the results. Dawn, I'll turn it over to you to get us started.
Good morning, everyone. This is Dawn Herman, and I'm a Senior Tax Manager in the R&D practice. And I'm delighted to see the results that about 2/3 of the folks on this webcast are familiar with the R&D credit. I am a CPA and have 12 years experience with the R&D tax credit. My colleague is going to be joining me in the presentation. His name is Daniel Kemp. He's a petroleum engineer with 5 years experience in the R&D tax credits, and he's completed numerous oil and gas R&D tax credit studies. The goal of this presentation is to provide an overall understanding of the R&D tax credit, address the myths that surround the credit, and to demonstrate how the credit can directly benefit companies in the oil and gas industry. Questions will be addressed at the end of this presentation. I'd first like to start with a brief history, a couple of highlights of the R&D tax credit. It was enacted in 1981 to promote technological advancements, to compete with emerging technologies from other countries, and to stimulate growth by providing incentives to companies that incur expenses engaging in R&D activities. The credit was temporary to begin with and was extended 15 times over a 30 year period. And the problem with the temporary credit was that companies could not plan or conduct R&D with any assurance that the benefit would be available to them. Often the credit was extended retroactively, which means it was the end of a year before anyone knew whether the credit was going to apply to that year or not. A big change that occurred in 2004 was the final regulations eliminated the discovery test, which was great for companies because the discovery test was the work, the activities, the projects had to be new to the world. And this was a very difficult challenge to overcome. So as a result of this change, numerous small and medium-sized companies across multiple industries were able to claim the credit for the first time. The PASS Act in 2015 made the tax credit permanent, and it also expanded some benefits to qualified or eligible small companies. In 2017, the Tax Cuts and Jobs Act also provides some additional benefits for the taxpayer, and we'll discuss this just a little bit later under a section on tax reform. So the federal credit, the federal R&D credit, what is it? It's a dollar-for-dollar tax credit that offsets tax liability or taxes owed. It's not a deduction. It can offset either income tax or payroll tax for qualified small businesses. There's no limit on the number of claims filed or the amount of R&D dollars available. The credit can be carried back 1 year, and unused credit can be carried forward for 20 years. You can amend tax returns for the past 3 to 4 years to claim R&D credits retroactively. This will provide a refund of taxes previously paid. Over 100,000 U.S. taxpayers are claiming more than $13 billion a year in R&D tax credits. And again, there's no limit on that amount. The R&D credit can be claimed by industries, multiple industries, including but not limited to oil and gas, manufacturing, aerospace, software, construction, architecture, engineering, food and agriculture, technology, and life sciences. And that's only a partial list. The state credit. You may not know, but a majority of the states, approximately 40, offer an R&D tax credit program. This credit can be claimed in addition to the federal credit, which increases the overall benefit. Some states have refundable R&D credits, and other states you can utilize the credit to offset either income tax or franchise tax, or it can also provide sales and use tax exemptions depending on the state. Typically, the state credits follow the federal regulations, but they may have some different tax rates or credit rates. The calculation methodology might be a bit different, but just remember that you can take the state credits in addition to the federal credits. And the R&D credit calculation does vary state by state. So what are the benefits of the R&D tax credit? Well, first and foremost, it provides a significant tax savings. The R&D credit can offset tax liabilities up to 10 to 15% of the total qualified R&D spend or the cost spent on R&D. As I mentioned, there's an additional state benefit. As I mentioned, you can carry the unused R&D credit forward for 20 years. And there are also carry forward benefits in each of the states, but it varies state to state. You can claim the R&D credit retroactively, as I mentioned, and overall, the credit provides an improved cash flow for companies. This is just an example of some of the studies we've conducted at Moss Adams and the results. And you will see that firms with larger annual revenue, meaning they probably had larger qualified R&D activities and costs have higher tax savings, R&D credits. I want to point out that the technology startup company has 0% revenue, but can claim up to a $250,000 credit, and I will discuss that just a little later. This is where the client can offset payroll tax liability instead of an income tax liability. And now, Emily, it's time for a polling question.
All right, our second polling question. Have you ever participated in or completed an R&D study? And your options are yes, no, or I don't know. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And I'll give everyone a few more seconds to make a selection. And let's go ahead and take a look at the results. Dawn, back to you.
All right. Well, I see it's a little more than half of you have not been involved in an R&D tax credit study. So hopefully this presentation will help you understand the benefits of the credit, and you feel free to ask questions, which we will address at the end of the presentation. So next I'd like to speak to what qualifies for R&D tax credit. Well, the activities. There's activities and costs, and I want to discuss activities first. Projects need to meet a 4-part test, and all 4 parts of the test must be met in order to qualify for the R&D tax credit, and there's no distinction between successes or failures if the activity meets all 4 parts of this test. Unsuccessful activities are a good indicator that R&D is occurring. So the first test is qualified purpose. This means that the intent of the activity is to create a new or improved product or process, software, technique, invention, or formula, and that results in increased performance, function, reliability, or quality. Technological in nature means that the activities rely on hard or physical sciences like engineering, computer science, chemistry, or biology. However, the individuals that work on R&D projects do not have to be degreed. The technical uncertainty and the process of experimentation work hand in glove. They are the focus of the 4-part test. And technical uncertainty means the activity is intended to eliminate uncertainty, problems, challenges concerning the capability or method for developing or improving a product or process or coming to a solution, or the appropriateness of design. And to resolve that uncertainty, there's a process of experimentation that is undergone to create activities to eliminate or resolve the uncertainty. It's a process that involves an evaluation of alternative solutions or approaches. It is performed through activities like modeling, simulation, numerical analysis, systematic trial and error, and or other methods. So just remember that it needs to be an iterative, systematic process. And again, the outcome or the solution does not have to be successful to qualify for the R&D tax credit. Now, for internal use software, I wanted to just mention that this is software that is developed primarily for taxpayers' internal use to support their business, such as HR or payroll, finance applications. These are typical back office applications. So if a company is doing that, in addition to the 4-part test I just reviewed, there are 3 more tests to determine whether the software is internal use or not. So if the software is not commercially available, if the development involves significant economic risk, and the software results are substantial and economically significant, then the additional tests do not hold. An example of software projects that are not internal use would be any software that is developed for sale, lease, or license, software that's used in R&D, software used in a production process that qualifies as R&D, software developed as part of hardware or software product, i.e. embedded software, and software developed that allows a taxpayer to interact with third parties or allow those third parties to initiate functions or review data on the taxpayer's system. Those are the examples of not internal use software. So the takeaway there is, remember, software that's developed for sale, lease, or license, or that's used in R&D qualifies for the R&D tax credit. If it's used internally for the business, then it's deemed internal use software and cannot be included in the R&D credit. Next, I'd like to discuss the qualified expenses for R&D tax credit. And those expenses are wages. And these are federal taxable wages for employees who either perform R&D, directly supervise the R&D, or support the qualified activities. Wages are typically the largest component of the R&D credit claim. The next expense are supplies, and these are costs for materials used in the R&D process. It does not include general administrative supplies and or capitalized assets. The third cost is contract research. These are activities that must be for R&D, and they must be conducted in the U.S. Many companies use contractors out of country, but their costs cannot be used for the U.S. R&D tax credit. The taxpayer must bear the economic risk, meaning they pay the contractor whether the project succeeds or fails. And they must retain the IP or the substantial rights to the results of the project. The fourth cost is rental or lease costs paid to a cloud service provider for hosting software under development. This does not include hosting a stable software or email. An example of these costs would be using, it has to be an external party server, it has to be off-site from the taxpayer's location, and it has to be used to develop and test new or improved software. So a new component is being developed there, off-site. So how do you identify R&D activities? If your company attempts to create products that are lighter, faster, and less expensive or more durable, reliable, or precise, the R&D tax credit adds up to money you can reinvest in your business rather than pay out to the IRS or to the state governments. The R&D credit eligibility is also much broader than many companies realize, as I've mentioned, how just a sample of the multiple industries the credit covers. And it doesn't only apply to the development of products, but activities of operations such as new manufacturing processes, environmental improvements, and quality enhancements can be included in the R&D credit. So if your company is designing or developing new or improved products, the employees are engineers or scientists or software developers or other types of technical folks, if you made an investment in customized equipment or develop new software, or if you have patents or patent applications, these are all indicators that R&D is occurring in your firm. Keep in mind that design build contracts involving innovative concepts or components also qualify. Engineering using the CAD, BIM, or other modeling software can qualify. Prototyping, modeling, and trial error testing qualify. And developing specialized machinery and tools qualify. So numerous industries, numerous activities can qualify for the R&D tax credit. So now, as promised, I wanted to talk just briefly about the most recent tax reform that has helped clients. The PASS Act permanently extended the R&D tax credit and expanded its provisions. The changes are effective for tax years beginning after 12/31 of 15. So the first enhancement to the credit was that the PATH Act allows startup businesses with no federal tax liability or gross receipts of less than $5 million to take the R&D tax credit against their payroll taxes. So this would be the FICA taxes, or the employer's portion of the taxes. This is beginning again after 20/31/15, so tax year starting January 1st of 16. And this essentially is making the credit a refundable credit capped at $250,000 per year for up to 5 years, which is a total benefit of $1.25 million. And that can be taken with no income or little income. In addition to the financial criteria, the qualified small businesses must be performing R&D activities and have payroll expense for wages to claim the benefit. The payroll offset is elected on the tax return, the federal tax return, but it's actually claimed on Form 941. It's important to note that the payroll offset benefit starts the first calendar quarter after the federal tax return is filed. So there is a form to elect this credit. It's Form 8974. It must be filed timely. If it is filed late, then the benefit is delayed until the next quarter starts. So you could have up to a 3-month wait for that benefit. So the second enhancement under the PATH Act was that small businesses are allowed to offset use the R&D tax credit to offset their alternative minimum tax liabilities. Again, it's for tax year starting January 1 of 16. The AMT restriction has long prevented qualified companies from utilizing the R&D tax credit because the R&D tax credit is not allowed to offset AMT. So this legislation removed that hurdle for eligible small businesses. And to be an eligible small business, you need to be a corporation that's not publicly traded, a partnership, or a sole proprietorship with less than $50 million in annual gross receipts for the prior 3 years. Now, even though the offset is allowed, there is a rule called the 25-25 limitation, which means that a taxpayer will be taxed on 25% of the taxes owed that exceed $25,000. So unfortunately, the taxpayer won't be able to take their tax liability all the way to zero. So the most recent tax reform, the Tax Cuts and Jobs Act, is the largest tax cut in American history, but it retains the R&D credit in its current form. There are several features of this act that could have a profound impact on companies that claim R&D credits and the ability to deduct research expenditures. The TCJA, as it's known, is effective for tax years beginning after December 31st of 17. And one of the biggest changes was that the corporate tax rate was decreased from 35% to 21%, which increases the R&D tax benefit net benefit from 65% to 79%, meaning you realize 79 cents on the dollar, which is a 14% increase. The corporate alternative minimum tax was eliminated. In the past, it was set at 20%. That meant that if, regardless of any credits or deductions, a corporation would still be taxed at a minimum rate of 20%. And again, the R&D credit could not be used to offset that AMT tax liability. Since the corporate AMT was eliminated, the taxpayer can now offset the R&D tax credit against federal income tax. However, the AMT limitation for R&D still applies to individuals. But the good news is that there are increasing, there may be an increased R&D credit usability from higher AMT exemptions for individual taxpayers, allowing them to use more of the R&D tax credit. Now, we're going to turn well, there's one more area I wanted to cover, and that's the net operating loss deduction limitation. The NOLs that a company might generate for tax years beginning after 12/31/17 can only offset up to 80% of the income and can no longer be carried back. Consequently, companies may owe more tax, but they can offset that tax with the R&D tax credit. And then I'd like to turn over the presentation to Daniel Kemp, and he's going to focus in on R&D and the oil and gas industry.
Thank you, Dawn. As Dawn mentioned, my name is Daniel Kemp. I'm a petroleum engineer. I worked in the oil field for some time. I'm now focusing on R&D credits for the last 5 years, and today I'm going to talk to you about kind of some of the activities we look for, as well as some of the employees we look at in the oil and gas industry. So within the oil and gas industry, there are many activities and costs that can qualify for the R&D tax credit that are usually not properly identified or utilized. Each stage in the petroleum production life cycle may qualify, as long as that 4-part test that Dawn mentioned, that test being a newer, improved process or a business component is what we call it, a product, having some technical uncertainty, so how you're going to do it, the way in which you're going to perform the R&D or the appropriate design, the process of experimentation you guys are going to go through, so the evaluating alternatives, testing alternatives to get to the final product or design, and then of course it must be seated in technological in nature, being engineering, chemistry, biology, etc. And some of the things about the oil and gas industry as far as why some companies haven't claimed it prior to, really just across all industries, there's a lack of awareness of the oil and gas credit. I know the poll, you guys are much more familiar of it than some other industries might be, but the education piece is what we strive to do and bring to the table as far as what the oil and gas, what the R&D credit is, and how companies can qualify. So some qualified employees that kind of key us into a company that might be performing R&D in the oil and gas industries. First being petroleum engineers that are working on new fields. A lot of times companies are going to be buying and selling their assets in different fields, and as such they're going to have to go in and learn those fields. Learn kind of the geology, what past production processes were, what past drilling processes were. So there's a lot of thought that has to go into developing these fields. And so a lot of the time petroleum engineers will be at the forefront of that development and working on different modeling aspects of it to try to get to the best solution in order to drill and produce and of course get that oil and gas to the marketplace. The next being mechanical engineers. So there's a lot of different infrastructure that goes into the oil and gas industry, as you know. There's various facilities, there's various industrial distribution facts that go into place, as well as industrial engineers and industrial distribution engineers. They're going to be working on different facilities, working on different tools, and various other infrastructure that's going to aid in the transportation, production, drilling of oil and gas. Next is electrical engineers that are going to be designing and implementing various electrical systems. There's a lot of monitoring that goes on in the oil and gas industry, which requires a lot of electrical design and very complicated electrical design. So next is pipeline engineers. They're going to be actually designing how to get oil and gas from a production site to the actual refineries and of course bringing it to the actual marketplace to the consumers. Pipelines are one of the to me, one of the bigger undertakings, just because all the variables that are involved. And next you have other supporting employees of those engineers like welders and skilled fabricators that are going to be working on various designs where they're actually in the real world trying to implement the modeled or the in-house designs. Oftentimes, the engineers' ideas and things of that nature don't translate to the real world. So those welders and steel fabricators will be providing some different alternatives, some feedback to the engineers to actually make that design come to life. And then finally, you have your CAD engineers and modelers. And as Don mentioned, there's a lot of modeling that goes in place on the construction side of oil and gas. So the different designs that go into that aspect of it, different iterations, different models, different prototyping. If companies are prototyping smaller scale designs in order to actually scale up to full scale construction, those employees can qualify as well. And so first, we're going to start with the upstream qualified activities. And upstream, as you know, is the kind of exploration production of oil and gas. And as I mentioned, different operators are going to come into different fields all the time. So that new operator needs to be familiar with that field. They need to understand the different drilling techniques, different completion techniques, and kind of refine those to what that specific operator's goals are. From a production, from a depletion, and also from an economic standpoint as well. And also, as we know, the environmental impacts that also take place in the oil and gas industry. There's a lot of different considerations that go into developing a field, developing specific welds, if you have a pad, if you have zipper wells, things of that nature. There's all different kinds of environmental testing, remediation, as well as observation throughout the development process. And so a couple of examples of different upstream activities that we see. There's different drilling mud systems that go into actually drilling a well. The different drilling muds have to be a certain consistency throughout the actual drilling process, and of course can change as geology changes, as friction changes. So those need to be changed on the fly, and I've worked with several drilling mud companies. And they were actually surprised to find out how much R&D they were actually doing when I started working with them. Also, you have directional drilling activities as well, from not only the tool standpoint and the rig, but also how you're actually going to drill the well. Drilling a well is not just putting a hole in the ground and you go down to where the oil is. There's a lot of different constraints that you have to run into, and of course, a drilling design doesn't. 9 times out of 10, it's not going to pan out the way you wanted it to. Fracking of wells, there's a lot of different completion designs that go into play based on geology, whether what kind of chemicals are actually going to be used in the fluid system, if it's going to be an acid well versus just a normal frack job. And then also we have disposal methods as well. Disposal methods are kind of go back to that environmental testing and remediation portion, where companies are going to try to figure out the best way to actually get rid of, dispose of unwanted fluids. Next, we have the midstream. First being the designing and construction of facilities and pipelines. As I mentioned before, kind of the pipeline construction aspect of it, to me, is kind of the most, the grueling and complicated aspect of it, just because of all the variables you have, not only from a land aspect of it, just from a logistics standpoint as well. You have cathodic protection and other corrosion control systems. Oftentimes, pipelines need to have pretty much a lightning rod on the pipeline, so lightning doesn't strike and corrode the pipeline. Corroding pipelines have to be shut down. They can be damaged. They can have explosions. Just a lot of dollars lost from a shutdown or a catastrophe standpoint. So there's a lot of protection and thought that goes into pipeline construction. The actual pipeline design and facilities design construction. So there's a lot of different systems that go into a facility design, where you have supervisory control and data acquisition, or SCADA systems. And you also have pump stations, which in themselves are pretty much an R&D project, because they have their own design, they have their own infrastructure, they have their own piping, sewer systems, etc. Next, we have LAC systems, which is the lease automatic custody transfer systems. And those themselves can be very complicated from a instrumentation and mechanical standpoint, depending how big they are, what's the nature of the fluid actually moving through them. Other metering systems. As you know, in the oil and gas industry, everything needs to be monitored at all times, whether it be mechanical monitoring, electrical monitoring, and all that needs to be communicated back to an office or a site that where engineers can understand the data, analyze the data, and make decisions on how to proceed with problems, or if everything looks great, things of that nature. And then also just, again, reiterating the electrical and instrumentation side of things that are going to be help governing these systems and help engineers make educated decisions, whether it be about problems or just the actual monitoring and understanding of what the data is actually doing to make an educated decision. Next, we have downstream and services. So downstream is where kind of the final phase in oil and gas's life, where you have the processing of it and to be made into usable products. And so with the facility design and construction, you've got a very complicated system of piping, instrumentation, pumps, etc. And it can be a very, not only expensive, but a very complicated process to make sure that all of those items work in harmony with your MEP systems, so your mechanical, your electrical, your plumbing, as well as your process engineering and also your industrial engineering components as well, making all those components in a harmonious dance, if you will, come together. You also have your chemical reaction process development, where you have your raw stream that comes into the refinery and then goes down its respective paths based on the actual products that are being made. You have various chemical engineers that have to be involved in that, industrial engineers. Pretty much every single engineering discipline is involved in the construction of an oil and gas refinery. And then you have also compressor design and manufacturing, where compressors are going to be used to compress natural gas. And one thing to note, the couple of compressor manufacturers I've worked with have had very substantial credits just due to the amount of supply costs that they have. And I can get into that here in a little bit more in a second. And also with services, you've got downhole tools, subsea tools manufactured. I had one client where it's the biggest client I ever worked on was a downhole tool manufacturer and subsea tools. You have actual rig builders. Developing an actual drilling rig is a very complicated process from a mechanical and, again, electrical and instrumentation standpoint. Auxiliary equipment in construction, those being different lube oil consoles or lubrication systems, separators, mud tanks, etc. Pretty much anything that goes onto a drilling platform or a fracking operation, going back to the whole developing of a refinery. And then finally, we have chemical manufacturing. Drilling fluids and fracking fluids are very complicated fluids to develop. So there's a lot of chemistry and R&D that goes in there to help develop what those chemicals are actually going to be doing from a mechanical standpoint. And then we also have the environmental aspects as well that go into the molecular makeup and the different chemistry that goes on to the development of those. And before I move on, going back to the compressor manufacturer, how Don mentioned the different supply costs that goes into it, there's another piece of it that has to do with kind of prototyping and pilot models. And a lot of the time, compressor manufacturers, as well as kind of some of these other areas as well, are developing custom machinery and equipment. And if it's a one-off project, we can typically take a lot of the materials that go into that. And compressors are very expensive pieces of equipment, as well as rigs, as well as these other items that I listed. And the dollars get pretty high pretty quick and generate some pretty substantial tax savings for those type of companies. And so moving on to a couple of examples, and these are actual examples that I've worked on personally, kind of going back to some of the examples I said earlier. So with a midstream company that worked on, this is a pipeline and facilities contractor. This is a single year $250,000 federal credit. And keep in mind, this was just a federal credit. There was other state implications as well. But $250,000 for a single year for just that one company. And then Downstream, we have a compressor manufacturer, and I worked with this client for several years, and their credit was year over year between the $400,000 and $6,000 range, averaging in that $500,000 range. And then next, we had my biggest client to date that I've worked with was a services company that made very complicated downhole tools and subsea infrastructure. This was a 4-year project that I worked on with over $10 million in federal and Texas credits. And then finally, one of my newest projects I worked on, which is a tool designer and manufacturer that made downhole tools. I saved them over $50,000 for a single year. And then next we have a polling question.
All right. Our third polling question, do you think your company is performing R&D? And your options are yes, no, or I'm not sure. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says slide deck and handouts to the right of the slide view. We will also be sending the slides via email after the webcast. I'll give everybody a few more seconds here. And let's go ahead and take a look at the results. Back to you.
So it looks like many of you think that about 2/3 almost, well, over half, think that your company is performing R&D, and that's great. So the next area we'd like to cover is the R&D study process. Moss Adams tries to make this process as straightforward as possible. It is broken into 3 phases. In phase 1, we do an initial assessment to determine the credit range. There is no cost for this assessment. It allows the client to make an informed decision whether they would like to proceed or not. And in phase 2, then if we're given the approval to move forward, we perform the field work, we interview the technical staff, we gather supporting documentation for the claim. And then in phase 3, we deliver a report that summarizes the methodology we use, the analysis, summary of the credits, and other pertinent documentation. And I'd like to cover some of the key takeaways. Through this presentation, I hope we've dispelled the myths that prevent a lot of companies from taking advantage of the R&D tax benefit. Several of the myths that we have addressed, they're just not true. And just kind of an example or some samples are, my business is too small to benefit. That's incorrect. Businesses of all sizes can benefit and claim the credit. Only companies involved in scientific research are eligible. That's incorrect. Companies doing everyday activities can qualify based on the tax definition of the R&D credit. The R&D credit does not help with state taxes. Well, again, we've demonstrated that's untrue, in that over approximately 40 states in the U.S. provide R&D programs, and that state benefit can be taken in addition to the federal benefit. Another myth is the credit can only be claimed on a current year tax return. That's incorrect. You can actually amend tax returns based on tax facts going back 3 to 4 years, depending on when the claim was actually filed, and that's for federal and for state. Another myth, the R&D credit cannot be claimed for failed development efforts. Again, incorrect. Failures count just as much as successful solutions and demonstrate that R&D is actually occurring. There's no distinction or differentiation between the outcome of the result as long as the 4-part test is met. And then again, another myth is that the R&D credit can only offset income tax. But that's not correct either, because now the credit can offset AMT, alternative minimum tax. It can also offset the payroll tax, tax liability. So regardless of what your company does, it's really worthwhile to look into the R&D tax credit. And in summary, just some highlights. The R&D credit can offer significant savings to all types of companies, including oil and gas companies. The definition of R&D is very broad, and it applies to all activities in all the phases of the oil and gas product life cycle. The payroll offset can allow companies with little or no income to take advantage of the R&D credit. And finally, Moss Adams is here and is a resource who can help you. So with that conclusion, we will move on to the final polling question.
All right, our final polling question. Are you interested in having an R&D assessment? And your options are yes or no. And once you have completed all CPE requirements today, you will be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. I'll give everybody a few more seconds to make your final selection. And let's go ahead and take a look at the results. Dawn, back to you.
So about a little under 30% of you are interested in having an R&D assessment, and that's great, and we're here to help with that. Emily, can you review the various ways that the audience can access our information and gain additional information about the R&D tax credit? I believe there will be some follow-up emails.
Yes, we'll be sending an email after the webcast with contact info and links to watch the recording of the presentation as well as download the slides. And if there's nothing further from Dawn and Daniel, we do have some time for questions. If you have a question for either of our presenters, you can enter that in the Q&A box beneath the slide view. And let's see, our first question is the payroll offset benefit unlimited or annual?
The payroll offset amount is limited. The benefit is up to $250,000 per year for 5 years, which could generate a total benefit of $1.25 million. However, any unused portion of that payroll offset can be carried forward for an unlimited amount of time until it's fully utilized.
Thank you. Next question, can previously filed tax returns be amended for the R&D tax credit?
And the answer to that question is yes. So typically there's a 3 to 4 year window pending on the statute for open years to actually claim credits. And there's also a situation where if companies are in an NOL position where we can actually go back to those loss years and actually claim credits and bring them forward 2 years in which companies are actually paying tax and offset further tax liability from those years with losses.
Great, thank you. Next one, what are the 4 qualifying costs for R&D?
Sure. So the first part, as Dawn mentioned, the first part is wages paid to employees, and those are federal taxable wages or Box 1 wages. The second component is supply costs. So they're supply costs that are used in the conduct of research or consumed. There's also, as I mentioned, with compressor manufacturers as the example, If there's prototypes or pilot models that are being developed, either from a custom manufacturing standpoint or just from a general development to try to mass produce a product or item, that's another portion of supply costs we can look at. Next is contract research, where a third-party contractor is actually performing research on behalf of the taxpayer or the company. And as a point of note, those companies need to, that contractor needs to be seated in the United States when performing that research. It can't be a foreign entity such as India or anything like that. And we can only take 65% of those expenses. And finally, their computer leasing expenses are usually based with software development companies. And this is for cloud-based research where they're using either Amazon Web Services or Azure as a cloud-based hosting service where they're going to be doing alpha testing of software development to debug and find problems in the architecture, and of course implement improved solutions to make sure that the software meets the actual functionality and performance requirements for that software.
Thank you. What are some examples of qualified supply costs?
The supply
So some
costs,
examples of some Go
sorry,
ahead, Don.
Daniel, go ahead.
So some qualified supply costs. I made a couple examples already, but a couple different examples going back to a chemical manufacturer, such as drilling mud or chemical fluids, doing test runs with those fluids, and they're actually being consumed. They're testing the actual performance of those items. That would be where we'd fall into that first part where materials are being used just in the conduct of research. And then next, going to the prototype model where you are actually developing a widget or a thing. There's prototyping that has to go into place where you're going to make either a batch run to test kind of performance and functionality, and then based on the results of that prototyping run, make some improved design solutions, or maybe even some improved manufacturing solutions, and we can look at those costs as well. And then finally, there's the actual pilot model, and a pilot model we typically see in a production plant where the actual plant is kind of the first of its kind. It's a never been done before process, and the entire construction and manufacturing components all go into this one pilot plant. There is an opportunity to take the full cost of an actual production facility if it meets those requirements that Don spelled out with the 4-part test.
Okay. How does the R&D credit affect the 2-year G&G amortization deduction? Is the 35% balance of contractor costs added to the G&G amortization?
So the 35%, let me explain how the contractors work. Again, we can only utilize 65% of the total costs paid for the contractors that are located in the U.S. And how it affects the 2-year G&G amortization deduction, let me check on that, Rob, and get back with you with a specific response.
Thank you. We do still have more time for questions, so if you think of anything, please feel free to enter that into the Q&A window. We have a couple more. How does the 65% contractor credit interplay with the IDC deduction? Is only 35% of the contractor costs then deducted as IDC? For GAAP, is only 35% of the contractor costs capitalized as exploratory well IDC?
I think, Rob, if it would be fine for us to contact you, we will address the contractor costs in more detail with you in one-on-one.
All right. Looks like we have one last question. Does a new chemical process, not a design, but a chemical process, qualify for this credit?
And to answer that question a little bit broadly, the answer would probably be yes, pending it meets that four-part test. We need to know a little bit more of the actual nature of the chemical process. But based on my knowledge of chemical processes and that development, I would err on the side of yes, it would qualify.
All right, that looks like all we had for questions. If you think of anything else that you'd like to ask Don or Daniel, you may reach out to them directly. And I would like to thank Don and Daniel for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete the survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.